Welcome back, and today we're going to talk about Loan Acronyms 101.
When you're doing a loan, you will notice that there are a lot of acronyms, a little bit of loan lingo, if you will, so it's helpful to understand what they all mean.
Exactly, and it can get kind of confusing, and a lot of times when you'll meet with lenders, it's just so much of our nature. It comes off naturally, and we forget. So always, if you're in talking with your lender, stop them and say, what are you talking about, when you start hearing these things being thrown out all over the place. So are we going to start with our first one?
First one, LE.
Ooh, I know what that is. I do. That's loan estimate.
Yes. So that is the first estimate usually you get when you go under contract or start a loan. We have 3 days by law to get that out to you. So loan estimate breaks down all of your fees for you in the beginning. So that brings us to our next one, the CD.
That's your closing disclosure.
Which is the final version, I think, kind of your loan estimate. So you get your closing disclosure at the very end, tells you all of your final numbers. You have 3 days after you sign your closing disclosure before you can officially close on your loan.
So that's kind of interesting. I never really thought of that when we talked about it. But your LE, from the start of your application, you have 3 days before it to go, and your closing disclosure, 3 days before you close. Get it? 3 days?
We really like that 3-day mark.
3 days.
All right, so next one. See if you know this one.
Oh, no. Here we go. Okay, I'm ready.
HOI.
Ooh! Homeowners insurance.
Oh my gosh, you're so smart. You're smart. All right, let's do PITI.
PITI. Principal, interest, taxes, and insurance.
So you will hear that a lot when we're talking about payments. The lenders will say your PITI is whatever. That means that you're escrowing for taxes and insurance. We're giving you your total payment, including the taxes and insurance portion of your payment.
Boom.
All right.
Okay.
Next one.
Well, I don't know. I'm on a roll. Let me ask you, and you can start bringing them on. I'm starting to get nervous. Okay. Yep.
This one's like kind of like a threefer. Okay.
Oh, 3. So I'm gonna get 1 for.
1 for.
Okay.
All right. So this one is a very common one that you will hear a lot in mortgage lending. LTV.
Ooh, loan to value.
All right. So loan to value is basically the opposite of your down payment. If you are putting down 10%, you have a 90% loan to value. If you're putting down 20%, you have an 80% loan to value. So that's the basics, loan to value. Then there is what's called a CLTV, right?
Yeah.
That one gets a little trickier.
Yep.
If you have a second mortgage, then your first loan is the loan to value, and your second mortgage, combining them, is your combined loan to value, or your CLTV, based upon the total value of the property. And then there's also HCLTVs, which has to do with home equity lines of credit and the max amount you could draw, but not necessarily how much you owe. It gets a little complicated, right? We don't expect you to remember all this, but it's good to know what it kind of all stands for. Okay, I have another one for you.
All right, I'm ready.
HELOC.
Ooh, HELOC. Home equity line of credit.
Way to break it down. Yeah. So that would be a second mortgage. Sometimes you see those go behind a first mortgage, obviously. It's called a second mortgage. And a home equity line of credit is basically just that, a line of credit where you can draw it out, pay it back down, draw it back out, unlike a regular mortgage where you just have fixed payments and you pay it down over a period of time. So HELOC is another one that we use quite frequently. All right, so I'm looking at my little list here. Oh, last one on my list.
Ready. What could it be?
I feel like people might know this one. APR.
Ooh, annual percentage rate.
Yes. So that one you will frequently see, well, you will see it all over the place. We have to quote it on everything we do every time we quote a rate. So if your note rate, which you're paying back, your principal is 3%, then your APR is likely going to be a little bit higher than that because you're going to have some fees associated with your loan. APR helps you take into account fees and note rate, kind of combines them. It's not all fees are APR fees. So that's a good thing to talk to your mortgage lender about so you understand the APR and the difference between the note rate and the APR.
And a big thing with the APR really is designed as a shopping tool. So as you're looking and combining and talking to people and you start getting quoted rates, you want to know the APR because one lender, right, could give them a rate of 3% and an APR of, say, 3.125, and another lender could say 2.875, but they're for the rate, but then their APR could be like 3.5. Well, that's a big jump from your rate, your initial note rate to the APR, what that's telling you is that there's a pile of fees in there that you're being charged. So it really helps you kind of
Compare
choose
loans,
and compare loans to see what is out there that you're comparing apples to apples.
Exactly. So APR is the super important one in mortgage. So that's what we have for you today. There's many, many more acronyms in mortgage, but those are the basics, 101, the ones you hear the most frequently. So please do not hesitate to ask, and if your mortgage lender starts using these, hopefully this will help you understand what they're talking about.
And again, if you don't understand, stop them and make them explain it to you.
Exactly.